At 2:47 a.m. Beijing time, a directive landed in the inboxes of China's largest exporters. Effective immediately, no more U.S. dollar transactions. By sunrise, bond yields were spiking, Wall Street was bracing, and global markets were tilting off-axis. 4 words, one directive. And the financial world cracked. No tweets, no threats, just a silent precision. And now a single question is echoing across every trading floor on the planet. Is this how the dollar loses its throne? Not through war, but through strategic silence. In April 2025, the Chinese Ministry of Commerce quietly instructed over 400 state-owned and private firms to halt all new payments settled in U.S. dollars, according to a leak verified by the South China Morning Post. The directive, described as non-negotiable, wasn't just financial housekeeping, it was a policy shockwave. Bloomberg reported an immediate 12.4% drop in dollar-denominated trade settlement volume out of China within 72 hours. Analysts at ING called it the clearest signal yet that Beijing is institutionalizing de-dollarization. But behind the policy was something more than currency strategy, a plan. The Yuan's share in global trade finance, which jumped from 4.5% in mid-2023 to 7.6%. By March 2020, SWIFT data is no longer riding momentum, it's being engineered. And with the digital yuan expanding into bilateral energy contracts, China's next move appears to be less about divestment and more about domination. But how does that translate into real-world financial collapse for the U.S.? The fallout began instantly. Within 48 hours of the directive, U.S. Treasury yields surged. The 10-year jumped 38 basis points to 5.09%, the highest level since before the 2008 financial crisis. According to J.P. Morgan, more than $212 billion in treasuries were dumped in just 4 trading days, much of it traced to sovereign wealth funds and Asian institutional investors. The People's Bank of China had already trimmed U.S. debt holdings from $859 billion in January to $729 billion by March. U.S. Treasury Department data. But this marked an acceleration, not a continuation. Mohammed El-Arian Al-Ayanz's chief economic advisor warned on CNBC that the shift could redefine the baseline for global borrowing costs. Meanwhile, U.S. bond market volatility spiked to levels not seen since March 2020. This wasn't a glitch in the matrix. It was a strategic signal. If the dollar is weaponized, Beijing will treat it like a liability. But if treasuries are no longer safe, what is dollar dominance has been eroding in silence for over a decade. IMF data shows global central bank reserves held in USD fell to 57.2% in Q1 2025, down from 71% in 2000. But the sudden cessation of dollar settlements by the world's second-largest economy may have tipped the balance. It's not just China, notes Eswar Prasad, former IMF official, in a Wall Street Journal interview. We're seeing a systematic decoupling among BRICS and even some G7-aligned economies. The yuan's usage in cross-border settlements rose to 48% in March, overtaking the dollar for the first time in Chinese trade data history. What's more, Saudi Aramco confirmed its first full oil shipment to India, settled in yuan, on April 18 as reported by Reuters. The reserve currency mantle doesn't disappear with ceremony, it erodes transaction by transaction. So what's replacing SWIFT? And why should Washington be worried? Pause the headlines. This wasn't panic, it was precision. And if this is China's opening move, what's checkmate going to look like? While SWIFT transmits over $5 trillion daily across 11,000 financial institutions, it's built on decades-old infrastructure. China's Enbridge, co-developed with the UAE, Thailand, and the BIS Innovation Hub, just completed a pilot in March, settling $23 million in cross-border trades, nearly real-time, fully traceable, and outside U.S. surveillance. HSBC Asia's head of digital infrastructure, Ananya Narayan, told Bloomberg that Enbridge proves real-time settlement across sovereign currencies without dollar intermediaries is not just possible, it's imminent. And while the U.S. debates CBDC rollouts, China's digital yuan already processes over $250 billion annually in domestic and cross-border settlements, according to PBOC data from April 2025. This isn't a futuristic proof of concept. It's live, and it's working. But as Beijing builds an entirely new financial bloodstream, Trump's response is already triggering monetary tremors at home. President Trump's April 19th Truth Social post was blunt: cut rates now, or we risk total collapse. Within hours, pressure mounted on the Fed. Yet a forced rate cut isn't a parachute, it's a pressure valve. The dollar index dropped from 104.3 to 98.7 in 5 days, the steepest weekly decline since 2009. According to Goldman Sachs, capital outflows reached $76 billion in April's third week alone, led by sovereign sell-offs and corporate hedging. The irony: lower rates may stimulate short-term lending, but erode faith in the greenback's long-term stability. Muhammad Ali El-Erian warned in the Financial Times that artificially cheapening the dollar will only accelerate flight into non-dollar assets, especially gold and yuan-linked commodities. The unintended effect is now visible in forex markets. For the first time in 40 years, the dollar lost value simultaneously against the yuan, yen, and ruble. So if Washington's fiscal engine is overheating, while Beijing rewires the power grid, who's really holding the switch? According to data from the Lowy Institute's Global Diplomacy Index and the IMF's Direction of Trade Statistics, as of Q1 2020, 128 countries now conduct more total trade with China than with the United States. This includes Germany, South Korea, the UAE, and even longtime U.S. partners like Australia and Chile. China's global export volume surged 8.9% year-over-year in Q1 2025, while U.S. exports shrank 3.2% over the same period, according to the U.S. Census Bureau. Bloomberg notes that China's rise is not just due to volume, but velocity, ramping up bilateral free trade deals across ASEAN, Latin America, and the African Continental Free Trade Area. In contrast, the U.S. has not signed a major new trade deal since the USMCA in 2020. As economic historian Adam Tooze writes in Foreign Policy, trade is no longer just economic gravity, it's strategic alignment, and more countries are leaning east. But if trade flows follow power, what happens when capital flows start reversing too? The U.S. economy contracted 0.7% in the first quarter of 2025, according to the Commerce Department's advance estimate, marking 2 consecutive quarters of negative growth. But that headline masks deeper structural fractures. Real wages are down 2.1% from a year ago. Consumer credit card defaults have spiked to 3.6%, the highest since 2011 per Experian. Small business bankruptcies rose 18% year-over-year in April, according to the Wall Street Journal. Meanwhile, mortgage delinquencies jumped 12% month-over-month, with Freddie Mac warning of a potential systemic stress scenario in its April 17th risk memo. Economists at Morgan Stanley now forecast a 40% probability of a technical depression by year-end, defined not just by GDP, but by prolonged multi-sector contraction. The Fed is cornered, raise rates, and the housing market implodes. Cut them, and the dollar bleeds. So what happens when monetary tools become geopolitical weapons? The latest ISM Manufacturing Index fell to 44.7 in April, its lowest reading since the early pandemic, signaling a severe contraction. U.S. export orders dropped 9.3% quarter-over-quarter, while import volumes at West Coast ports, long a barometer of global trade health, plunged 27% year-over-year, according to Port of Los Angeles's April data. The American Association of Exporters reports that nearly 1 in 5 major manufacturing exporters have lost access to key Chinese suppliers following Beijing's capital payment ban. Boeing, once America's largest exporter, saw $14.2 billion in order cancellations in the first quarter, more than double fourth quarter 2024 levels per Reuters. Meanwhile, trade credit insurers like Euler Hermes are slashing U.S. exposure limits, citing non-payment risk volatility. If the arteries of trade are clogged, leadership becomes irrelevant. But the deeper question may be, is the real damage coming not from Beijing, but from Washington? The U.S. government's own fiscal behavior is eroding the very foundations of dollar trust. In just the first 4 months of 2025, the federal deficit has already surpassed $1.3 trillion, driven by rising entitlement spending and emergency monetary stabilization efforts, according to the Congressional Budget Office in April. Meanwhile, foreign central bank holdings of treasuries have fallen to 38.6% of total issuance, down from 44.9% in 2019, per the Treasury International Capital Report. China's pullback was expected, but what's new is that allies like Japan and Belgium have also reduced their U.S. debt exposure by 11% and 14% respectively in the first quarter alone. Even the Saudis cut holdings to a 9-year low. Mohammed El-Arian told Bloomberg, surveillance confidence isn't lost overnight. It's eroded by erratic fiscal management and weaponized economic policy. The U.S. didn't just wake up in a world with fewer buyers, it pushed them away. So the real question is no longer whether the dollar is being targeted, but whether it's being self-sabotaged. So if China is strategically cutting the dollar cord, and the U.S. is fraying it from the inside, who's actually in control of the global financial future? Because as the UN gains ground, treasuries lose prestige, and America's own policies accelerate disinvestment. The next domino might not be a trade deal or a currency swap, but a global reserve rotation. And if that starts, the consequences won't just be on Wall Street. They'll hit pensions, payrolls, and prices in every American household. But here's the part no one's talking about. What if this isn't the final blow, but the setup for something even more disruptive? So ask yourself, is the world preparing for life after the dollar? Or is the U.S. writing its own financial obituary? We're glad you're enjoying this video. Please like and subscribe. China didn't just roll out a digital currency. It unleashed a $1.2 trillion financial framework that could rewrite how money moves across borders. Quietly, systematically. And while much of the world's still tangled in swift wires, Beijing may have just cut the cord. So what exactly is this new system? China just activated a $1.2 trillion digital Yuan payment architecture that's already settling transactions across 200 countries and regions without touching SWIFT. According to data from the People's Bank of China, the digital yuan has processed over 1.8 trillion yuan, or $250 billion in pilot settlements as of the first quarter of 2025. This isn't a volume play, it's a sovereignty play. By embedding the ECNY into trade corridors, supply chains, and cross-border central bank networks, Beijing is re-engineering the post-dollar era from the inside out. Martin Chorzempa, senior fellow at the Peterson Institute, told Bloomberg this represents the first state-run infrastructure that could compete with the SWIFT IBAN-dominated order. In 1944, Bretton Woods crowned the dollar king. In 2025, Beijing is quietly challenging that crown without a single gunshot, but with programmable code and bilateral swap lines. But if this is China's monetary Manhattan Project, then its next move could reveal how deep its global ambitions really run. Since 2015, Beijing has signed over 41 bilateral currency swap agreements, valued at roughly $580 billion, forming a decentralized financial web that allows direct RMB trade, bypassing dollar clearing banks. As of late 2020, 38% of China's total trade is now conducted outside of SWIFT, per the Financial Times, largely through the CIPs or cross-border interbank payment system, which now connects over 400 financial institutions across 110 countries. In practical terms, that means energy shipments from Saudi Arabia to China can now clear in yuan within seconds, with no U.S. intermediary banks involved. While SWIFT remains dominant globally, handling about 40 million messages per day, its grip on emerging market trade has visibly weakened. The silent build-out of a parallel financial architecture by China is one of the most underreported financial revolutions in decades, notes Eswar Prasad, former IMF China division head. But it's what China does next with this alternative pipeline that could turn a workaround into a weapon. The exodus from the dollar isn't ideological, it's structural. In March 2024, Kenya purchased oil from the UAE using Chinese yuan, bypassing the dollar entirely, a move confirmed by President William Ruto himself. Meanwhile, Argentina repaid part of its IMF loan in yuan, not dollars, after exhausting its greenback reserves. According to SWIFT's RMB tracker, Yuan's share in global payments surged to 4.6% by February 2020, up from just 1.9% 2 years prior. The acceleration isn't random. It's a direct result of nations hedging against U.S. monetary sanctions and dollar liquidity constraints. Countries aren't ditching the dollar, they're insuring against it, says former World Bank economist Carmen Reinhart. The digital yuan, built with programmable features and no dependence on correspondent banks, gives these nations a plug-and-play alternative that sidesteps Washington's financial gatekeeping. But whether this is decentralization or just re-centralization under Beijing remains an open question, one that may be answered by how many countries sign up next. In a cross-border test between Hong Kong and the UAE in late 2023, the digital yuan cleared trade invoices in seconds while cutting costs by up to 98%, according to a report by the Bank for International Settlements. Unlike SWIFT, which only transmits messaging instructions, the ECNY system executes actual value transfer in real time, reducing reliance on intermediary clearinghouses and eliminating foreign exchange delays. With SWIFT averaging 1 to 3 business days for cross-border settlements and costing up to $50 per transaction for SMEs, China's alternative offers speed and savings at industrial scale. China's not just building a faster rail line, they're cutting out the ticket booths, said Josh Lipsky, former IMF advisor and director at the Atlantic Council's Geoeconomic Center. The system's backbone, CIPS, integrated with the digital yuan, now handles an average of $83 billion in daily transactions. That's no longer experimental, that's operational. But with speed comes surveillance, and who holds the kill switch? That's the question global regulators are starting to ask. In 2024, ASEAN surpassed the EU to become China's largest trading partner, accounting for over $975 billion in two-way trade, according to China's Ministry of Commerce. But beneath the headline is a structural shift. More than 33% of ASEAN-China trade is now settled in non-dollar currencies, with the ECNY rapidly expanding its footprint through regional banks. In Indonesia, QR code-based ECNY wallets are being used by SMEs to bypass delays tied to dollar conversions. In Malaysia, Bank Negara partnered with China's central bank to directly link their fast payment networks, a first for the region. Beijing isn't just exporting goods anymore, it's exporting financial norms, says Alicia Garcia Herrero, chief Asia-Pacific economist at Natixis. And those norms come embedded with dependence. When the rails, rates, and settlement systems all flow through Chinese platforms, regional autonomy starts to erode, even if sovereignty technically remains. But what happens when ASEAN's largest economies become digitally tethered to the yuan? That's where China's influence morphs from transactional to structural. Washington's sanction strategy, once seen as a tool of financial supremacy, is now accelerating the creation of alternative systems. Since Russia's swift suspension in 2022, CP's transaction volume has increased over 90%, reaching an average of $83 billion per day by early 2025, according to the People's Bank of China. That expansion has paralleled a surge in digital yuan adoption among sanctioned and dollar-strained economies, with cross-border pilot settlements hitting 1.8 trillion yuan, or $250 billion. Bloomberg reports that China expanded bilateral swap lines with Brazil, Pakistan, and Saudi Arabia, after each faced dollar access constraints in 2023. The more the U.S. turns the dollar into a compliance weapon, the more attractive Beijing's rails become, says Eswar Prasad, former IMF official. Even allies like Indonesia and the UAE have begun testing yuan settlements in oil and agriculture. But here's the contradiction. America's tools were meant to isolate, yet they're incentivizing precisely the systems designed to bypass U.S. control. If isolation breeds innovation, then the next breakthrough may not come from Silicon Valley, but from Shanghai. China's Belt and Road Initiative has poured over $1.1 trillion into infrastructure projects across 148 countries. But what binds that network isn't just railways or ports. It's currency settlement control. And the digital yuan is fast becoming the preferred glue. In Pakistan's Gwadar port, Kenya's Mombasa terminal, and Laos' high-speed rail corridor contractors are now being paid in ECNY, with funds routed through digital wallets backed by the PBOC. Bloomberg confirms that at least 13 BRI-linked nations are piloting RMB-based digital settlements. And in some cases, ECNYY is being embedded into sovereign debt servicing tools via smart contracts. This isn't just finance, it's programmable alignment, says Alicia Garcia Herrero, chief economist at Natixis. The advantage for China. It doesn't just lend the money, it controls how it's spent, tracked, and potentially reclaimed. But if ECNY locks nations into a closed system, is Belt and Road still infrastructure or digital colonization by another name? The BRICS bloc, now expanded to include Saudi Arabia, Egypt, and the UAE, has quietly transformed into a currency lab. At the 2024 Johannesburg Summit, members agreed to prototype an interlinked system using national CBDCs as clearing agents, with China's digital yuan leading in real-world use. According to the Atlantic Council's 2025 CBDC tracker, 4 BRICS central banks are now running cross-border pilots, using non-dollar currencies, while SWIFT's own data shows RMB usage overtaking the euro in portions of South-South trade. This is not de-dollarization through destruction, it's fragmentation through innovation, said Josh Lipsky, director of the Atlantic Council's Geoeconomics Center. And as Brazil and Russia push for a shared settlement framework by 2026, the dollar's role as the global medium is under structural revision. But if each region now builds its own financial lane, who governs the intersections? Trump's renewed tariff policy, unveiled in January 2025, proposes a 60% blanket tariff on all Chinese imports, double the rate from his first term. But the Chinese response hasn't followed the old script. Instead of tit-for-tat duties, Beijing accelerated ECNY integration into its export financing. According to a Q1 2025 report by the China Securities Journal, digital yuan usage in trade settlements rose 19.3% year-over-year, with state banks offering exporters ECNY trade credits with lower interest than dollar loans. Meanwhile, Hong Kong-based institutions like Bank of China International now offer yuan-denominated letters of credit for ASEAN shipments at up to 40 basis points cheaper than dollar equivalents, per the South China Morning Post. Tariffs may hit exports, but they're also pushing China to speed up a monetary firewall against U.S. leverage. Notes: Mark Sobel, former U.S. Treasury official, in a WSJ interview. The unintended effect: Trump's economic pressure is accelerating the very network designed to insulate China from future pressure. But if tariffs can't contain China and only fuel its alternatives, then what leverage does the U.S. still hold? This isn't a trade dispute anymore. It's a competition to build the next global financial nervous system. The dollar isn't vanishing, but its role as the world's gatekeeper is being reprogrammed in real time. While the West debates tariffs, China's laying programmable rails, embedding them in infrastructure deals, regional trade pacts, and even digital wallets offered through Belt and Road banks. And it's not just about payment. It's about surveillance, programmable disbursement, and geopolitical control embedded directly into financial flows. A system where money moves only if the algorithm and the issuer allows it. So here's the question you need to ask. If Beijing controls the rails, the rules, and the routes, what happens when the next crisis hits? And the world needs liquidity, but not from Washington. Because China's not just preparing for the next financial war, it's preparing to win it before it even starts. Because when the next global crisis hits and the liquidity lifeline doesn't come from Washington, will the world be ready to accept Beijing's terms instead? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.